Hi, and welcome to this edition of the Options Learning Center. My name is Rick Orford, and I've been a stocks and options trader since 1999. And today, I publish content for some of the most prominent publications, including Bar Chart. In this video, you'll learn how to buy calls and use Bar Chart to get the most out of the strategy. A call option gives the buyer the right, but not the obligation, to buy 100 of the underlying asset at a specified price, the strike price, within or at a specified time, which is the expiration date. The buyer pays for that option by paying a premium. And a buyer of a call option is said to be long, hence the term long call. Call options are used when the buyer is bullish on the market, or the investor has a reason to believe that the underlying asset's price will increase above the strike price on or before the expiration date. As a result, long calls aim to profit from the anticipated rise of a specific stock or underlying asset. If the option premium exceeds what the buyer paid before expiration, the buyer can sell the call option at a profit. Alternatively, the buyer can exercise an in-the-money call and buy the underlying shares at the strike price, hold them, or sell them to the market for a profit at any time. Let's use Bar Chart for some trade examples using long calls. Bar Chart's Option Screener feature allows you to screen the entire market for long call trades that fit your criteria. To access the long call screener, simply navigate to barchart.com if you aren't already there, then click on Options, and then click on the long call screener. Once there, you'll be presented with a list of call options that you can choose. Before entering a trade, you do need to consider a few values. First is the strike price. Do you want an in-the-money call, which is safer but more expensive, or an out-of-the-money call, which is cheaper but riskier? Next, the expiration date. Longer expiration dates allow more time for the underlying security to move upward. Typical long call trades expire in 30 to 45 days, but they could be a lot longer depending on the strategy. Lastly, we have the premium. With long calls, your maximum loss is the premium that you pay. And that loss happens if the underlying stock price is at or below the strike price. You may also prefer to tailor fit your screens to reflect different strategies and risk profiles. To customize the screener, click on the Set Filter tab. You can then select from dozens of filters, such as option details, analysis, and even underlying stock information. As you can see, there's many default filters already in place for the long call screen. For simplicity, I'm going to remove most of these filters, but I am going to keep days to expiration, security type, and ITM probability. ITM probability means the probability that the option will expire in the money. Traders often consider ITM probabilities as a way to increase their chances of profit. While ITM probability does not equate to the probability of making a profit, it does give traders a good idea about the trade's potential direction. To profit with a long call, the premium must now be higher than you paid, and that happens when the underlying stock price exceeds the trade's break-even price at expiration. Options traders commonly use long calls with varying probabilities. Just remember that safer options trades usually mean lower premiums. So now I'll screen for calls on stocks and ETFs with a probability of expiring in the money between 60 and 70%, which I think is a good balance for relatively low premiums and a high chance of profit. Then I set the days to expiration for between 30 and 45 days. And then I click See Results. And now I have a target, Apple. By the way, clicking on the plus sign beside the ticker symbol will open a small window to see the stock's price chart, along with other sections like news, quotes, technical analysis, and so on. In any case, we now have our underlying stock. This long call option is a bit conservative as it's already in the money. The premium is a little more expensive than it would be if it were out of the money, but since it already has intrinsic value, it's a safer trade than buying something that's more speculative. Traders can exit long calls by selling the call to someone else or by exercising the option. Let's say that Apple's price reaches $240 at expiration. Should you decide you want to own the shares, you can exercise the option and buy 100 shares of Apple at $210 each. That's the contract price. That'll be your cost base for the trade. Of course, you need $21,000 to make this happen, and you'll be up $3,000 on the trade. Let's assume it's July 5th, and there's 14 days left to expiration. Apple stock is now $240 a share, and you decide you want to sell the option at a profit. In this case, your long call is in the money and has $30 of intrinsic value. However, since it still has 14 days before expiring and still has the potential to increase, your long call option will also have extrinsic value, making it more advantageous to sell the option than to exercise it. Let's say people are willing to pay $10 more. So now you can sell your long call for $40. The premium is the extrinsic value and the intrinsic values combined. To calculate the total profit from selling your long call, take the total premium received from selling the call and subtract the premium paid at the start of the trade. The trade will enter its maximum loss condition if Apple's prices move below your long strike. Suppose that happens and Apple trades at $190 at expiration. The maximum loss is calculated by multiplying the premium paid by 100 for every long call option. To better illustrate the profit and loss scenarios of a long call, here's your expected returns at different price points, assuming that you exercise the option and sell the shares to the market at expiration. Suppose you've identified a stock that you like and you know very well and you might want to buy. Bar chart allows you to screen for different option strategies for specific stocks. All you need to do is go to the stock or assets profile page on barchart.com, navigate to the left-hand side of the screen, and click on your preferred option strategy. Another way to do this is to add the symbol filter on the option screener page, and then type in the company ticker symbol fully or partially. Now, let's talk about some pros and cons of long calls. A long call's strongest benefit is its unlimited profit potential. As the underlying asset's price moves up, the call option's value can increase significantly, offering you substantial gains. Long calls also have limited risk and provide leverage by controlling a large amount of the underlying asset for a relatively small premium. Furthermore, long calls can be used in various trading strategies, providing flexibility in managing investments and hedging risks. Lastly, unlike purchasing the underlying asset, buying a call option requires less capital, making it accessible to more investors. However, call options lose value as they approach expiration, and this is known as time or theta decay. If the underlying asset's price does not move much or quickly enough, the result can be eroding profits. The investor also loses the entire premium they paid if the underlying asset does not rise above the strike point before the option expires. Furthermore, while leverage can amplify gains, it can also amplify losses. High volatility can lead to significant price swings, which might result in the option expiring worthless. The premium cost can also be very high, especially for options with longer expirations or higher implied volatility, and this can reduce your overall profitability. Finally, predicting market movements can be challenging. If the underlying asset's price remains stagnant or falls, the call option can rapidly lose value. Here's some other considerations before trading long calls. First, it's important to do your research. Make sure you understand the underlying asset thoroughly. Research its historical performance, market trends, and price movement factors. Next, remember to monitor volatility. High volatility increases options premiums, while low volatility may offer cheaper options but less potential for significant price movement. Remember to set realistic goals. Have a clear profit target and risk management strategy in place. Determine in advance at what price you'll sell to take profits or cut losses. Don't forget to track market conditions. Stay informed about broader market conditions and economic indicators that could impact the underlying asset. This will help you make timely decisions and trade adjustments. And use technical analysis tools to identify entry and exit points. Chart patterns, moving averages, and other indicators can also provide valuable insights into price movements. Also, be aware of the effects of time decay, especially if you hold options close to their expiration date. This is particularly important for speculative long calls, since the closer it is to expiration date, the lower the premiums. And finally, don't trade blind. Use options trading platforms and tools like screeners and charting to gain analytical insights, real-time data, and risk management features. Long calls can be a great way to profit from significant price movements. While the risks are limited, traders are encouraged to maximize their potential profits by using tools like bar charts option screener and, of course, checking the asset's fundamental and technical properties through the website.